In our today's video we are going to learn everything about liquid funds. So let's go. Liquid funds, also known as money market funds, are a type of mutual fund that primarily invests in short-term, low-risk securities. These funds are designed to offer investors easy liquidity and preserve capital while providing a modest level of return. Here's everything you need to know about liquid funds. 1. Objective and investment strategy. Objective. The primary objective of liquid funds is capital preservation and liquidity. They aim to provide investors with a safe investment option that offers stable returns and easy access to their funds. Investment strategy. Liquid funds invest in highly liquid, low-risk instruments such as treasury bills, certificates of deposit, commercial paper, and short-term government securities. These securities have short maturities, typically less than 91 days, which helps ensure easy liquidity and minimize interest rate risk. 2. Characteristics of liquid funds. Liquidity. Liquid funds offer daily liquidity, allowing investors to buy or sell units on any business day. When an investor requests a redemption, the fund generally pays out the proceeds within 1 or 2 business days. Low volatility. Liquid funds have relatively low volatility compared to other mutual fund categories due to their focus on short-term, low-risk instruments. Stable NAV. Liquid funds aim to maintain a stable net asset value (NAV) of around 1 Indian rupee per unit. However, the NAV can fluctuate slightly due to changes in interest rates and the market value of the underlying securities. 3. Returns and taxation. Returns. Liquid funds typically provide modest returns, which are generally in line with prevailing short-term interest rates. The returns are generally higher than traditional savings accounts or fixed deposits but lower than other mutual fund categories. Taxation. Short-term capital gains, held for less than 3 years, from liquid funds are taxed at the investor's applicable income tax rate. Long-term capital gains, held for more than 3 years, are taxed at a flat rate of 20% with indexation benefits. 4. Benefits of liquid funds. Liquidity. Investors can access their funds quickly and easily, making liquid funds suitable for emergency funds, short-term goals, or parking idle cash. Capital preservation. Liquid funds aim to preserve capital by investing in high-quality, low-risk securities with short maturities. Diversification. Liquid funds offer diversification by investing in a range of short-term instruments issued by different entities, reducing concentration risk. Cost efficiency. Liquid funds generally have low expense ratios compared to other mutual fund categories, making them cost-effective investment options. 5. Considerations. Lower returns. While liquid funds provide stability and liquidity, they tend to offer lower returns compared to other mutual fund categories that carry high risks. Interest rate risk. Although liquid funds are designed to minimize interest rate risk, changes in interest rates can still impact the NAV of the fund, leading to slight fluctuations in returns. Credit risk. While liquid funds focus on low-risk instruments, there is still a possibility of credit risk if the issuer defaults on the underlying securities. However, credit risk is relatively low due to the short maturities and diversification practices of liquid funds. 6. Regulatory framework. Liquid funds in India are regulated by the Securities and Exchange Board of India, (SEBI). SEBI has defined guidelines and investment restrictions to ensure the safety and liquidity of these funds. Before investing in liquid funds, it's essential to consider your investment objectives, risk tolerance, and liquidity needs. Assessing the fund's investment strategy, expense ratio, credit quality of the underlying instruments, and the fund manager's track record can help you make informed investment decisions. Consulting with a financial advisor can provide personalized guidance based on your specific financial goals and circumstances.